A lot of people still looking for more commodity strength as the Fed starts to pull back in its economic stimulus program. Here to talk about that and whether this recovery is sustainable without commodity strength is Dan Dicker. Dan, what do you think?
Well, Joe, I mean, there's been a dichotomy kind of going on in the market. I mean, I'm commodity-centric kind of guy, having done this my whole career. And I've never seen a recovery that was sustainable without commodity strength. Now, oil being on a different planet altogether, some of the ones that I look at, like copper, other base metals, zinc, tin, if I look at coal, for example, these have been very, very, very weak commodities over the last several years. I mean, you look at the stocks of some of the coal stocks, Peabody, Alpha Natural Resources, you look at some of the copper companies, Vale or Freeport. I mean, they've been bad stocks, and that tells you something. The commodities haven't been there to support this kind of run-up. It's really been kind of a Fed-induced run-up to a certain degree. But now that you know, we have a reality, at least, of tapering, and it seems like a real reality.
Right.
Comments from the Fed yesterday that even, you know, a 340-point drop in the Dow doesn't really stop their ideas of tapering. They're going to go forward with tapering. The question remains, can we sustain, you know, our recovery and our strength without the strength of these two base metals, which, you know, really impact, you know, emerging market strength and ultimately, you know, the global economy.
Yeah. So what are you expecting out of these base
Yeah,
metals?
I'm really, you know, I'm in a quandary right now. I'm very, very careful about a lot of these the stocks right now. I don't want to dismiss, for example, emerging market numbers that are coming through, because the commodities have told me that story well before the PMI numbers in China told me a story of a number dropping under 50, for example. So at this point, I'm very much tending towards cash, very much tending towards bond-like plays in the stock market, and not the kind of speculative high beta type of stocks, you know, that you would want in a strong bull market.
So let's look at one more thing. The worst stocks in the last 2 years that you've been talking about, and what this means overall. Then.
That's right, exactly. You look at those stocks, and they are because the commodities are so weak. So all of the miners have been bad, all of the coal stocks have been bad, and that's a bad sign for a sustainable recovery. And it may presage, in fact, a little bit more than what has been called, at least so far, a correction of a bull market. It may presage something a little bit worse than that. We'll have to see.
Sure. So maybe not time to freak out right now, but definitely worth keeping an eye on.
Definitely worth keeping an eye on, adjusting your portfolio away from high beta and into something a little safer, something with a little more dividend and yield.
All right, Dan Dicker, thanks so much.
Right.
And for The Street, I'm Joe Deaux.